All right. Hello, everyone. This is Carter. Today, I'm going to be giving an accounting crash course. Accounting is a super important concept for understanding finance and investing, along with just how a business is doing. Today's just going to be a quick overview of accounting and more specifically the three financial statements. And then I'm going to make a few more lesson videos going a bit deeper into accounting so you can really have a good, understanding of all of it. But I'll just get started here. What is accounting? So accounting is the language of business and the backbone of finance, right? It is the means through which we can describe the economic activities of business. I've talked a lot about how we as investors care about the cash flows that a business produces and also the riskiness of these cash flows, right? That's the entire concept of like a discount rate. Well, accounting really helps us understand, the cash flows that a business can generate and also the riskiness of those cash flows. And because there's so many stocks out there, the United States Securities and Exchange Commission kind of regulates the way that a business can display its financial numbers, right? It's called the Generally Accepted Accounting Principles or GAAP accounting. This basically standardizes the way in which a business reports all its metrics. So they're all like using the same general rules as far as it's like accounting goes. And there's S1s, 10Ks, and 10Qs. These are all just kind of forms SEC forms that a business releases where you can see their financial statements and other things about the business. An S1 is what a business has to file when they initially go public. A 10K is an annual report that a business would release once a year. And then a 10Q is a quarterly report which a business would release each quarter. But yeah, accounting is just super important. It really is like the backbone of finance because you really need to understand accounting to understand how a business actually doing financially. There are three financial statements. There's the income statement. This, also called the profit and loss statement, just shows a company's revenue and all of its costs to calculate net income for a certain period of time. And net income is essentially, like layman's terms, profit, right? It's all of your revenue minus all of your expenses that equals your profit. The cash flow statement shows all the ways the cash is flowing in and out of your business operationally, through your investing, and through your financing for a certain period of time. Both the income statement and the cash flow statement are for a certain period of time. For instance, you could have an income statement and a cash flow statement for like one quarter or for like an entire year. The balance sheet, conversely, is like a snapshot of the company's assets, liabilities, and shareholders' equity. So at a specific point in time. And you can kind of just think of this as the company's assets and then the claims on those assets. You have like debt holders and equity holders. They all have claims on a company's assets. So this is kind of why this equation I'm going to talk about in a little bit makes sense. But these are the three financial statements, and just know that they are all very interconnected and really all are super important for understanding how a business is doing operationally. So the income statement, this first one, shows a company's revenue and all the expenses to calculate net income or profit. Revenue is just all the sales from the core operating activities for a business. Expenses are the costs associated with running the business. So you have cost of goods sold or COGS. These are really expenses that are like directly associated with revenue. Like if I am a lemonade stand business, the COGS would be the lemonade that I'm selling, right? Or if I am a hair salon, it would be the direct labor associated with cutting hair. Sales general and administrative SG&A is less direct, right? Where COGS is more a variable cost. If you take in microeconomics, sales general administrative is a fixed cost. It really shouldn't change when your revenue is fluctuating. This could be like salaries for management or marketing expenses, utilities like electricity, or like a rent expense. These are all examples of SG&A. You have depreciation and amortization. Depreciation is basically like if you have long-term assets, they would be getting depreciated or decreasing in value over time, and this would be reflected on the income statement, as well as intangible assets, which would be amortized over time. And I'm going to talk about that more in a little bit. You have interest expense, like if you have debt, you would pay interest on that, and that would be on the income statement. And you have taxes, right? If you have your pre-tax income, and then you get taxed on it, and then you have your profit. So those are all like the main core expenses. And it's really important to understand this concept. The income statement is done on an accrual basis rather than a cash basis. So this essentially means that revenues and expenses are recorded when they are earned or incurred, regardless of when the cash is actually received or paid. So I'll give a little example of this. Let's say it's January. I operate a lemonade stand, and a lady pays me $20 for 10 free cups of lemonade in February. Under accrual accounting, it is January, and I'm recording this financial statement for just January, right? I'm operating this lemonade stand, and a lady pays me $20 for 10 free cups of lemonade in February. So I'm getting this money right now, right? My cash is going up in January. However, I am not providing the good or service until February. So accrual accounting states that this would not show up as revenue for this period of time in January because I've not actually, done the good or service, right? So that's basically accrual accounting. Cash accounting would say, no, you got $20 in revenue. You got the cash from a good or service. It doesn't matter when you're actually fulfilling that good or service. But accrual accounting is how you do the income statement. So on the income statement, this first one, it would not show as revenue. The second one, a man buys $10 of lemonade from me and promises to pay it in February. This is kind of the opposite, right? The guy is buying lemonade from me now. I'm providing him with this good, but he says he's not going to pay it to me until February. So in this case, I would actually record this $10 as revenue on my income statement because I'm, providing the good in this period. The third one, I buy lemonade inventory and sell it in February. This one is another interesting one. I'm actually paying the money for the inventory in January and then selling it in February. Same thing, right? It is when the expense is incurred, and it's incurred when we're actually selling the lemonade. So it would not show up on the income statement until we actually sell this inventory. So it'd be in February. So in January, there would not be any cost of goods sold associated with this, third bullet point, because we're not actually selling that inventory during January. Fourth, I sell lemonade that I bought in December. This is kind of the opposite again, right? We bought it in December, so the cash left us in December. However, we actually sold this lemonade, incurred this expense in January. So it would show up as, cost of goods sold in January. So that's kind of how accrual accounting and cash accounting works. The income statement is all accrual accounting. And this is really good for consistency, right? If a business did cash-based accounting on the income statement, they could do some, suspect things, like they could get a lot of people to prepay for their goods and services, like right at the end of the period. So they would basically be kind of lying to investors, like, oh, we're doing really good. We're getting our revenues grew. But in reality, it was just because they got a ton of people to prepay at the very end of the quarter. This is a better way, I believe, to actually show how much a company is generating in revenue and all the expenses associated with that revenue. So that's why they do the income statement with accrual accounting. So income statement line items. This is an example of an income statement in the way that it looks. So you start out with your revenue here. I say my lemonade stand company is $100 of sold lemonade during that period. So it's important to note it is during that period where you're actually, selling the lemonade. So it's $100 there. The lemonade itself and the direct labor cost $40 total. So those are direct costs associated with producing that revenue. So those are cost of goods sold. Gross profit is our revenue minus our cost of goods sold, right? So when you think about gross profit, that basically is just showing revenue minus cost of goods sold. So you go from revenue to cost of goods sold to gross profit. And then marketing and rent cost $20, and depreciation expense for my lemonade stand was $10. SG&A and depreciation and amortization are both operating expenses. So you subtract all your operating expenses from your gross profit, and this gets you to your operating profit. So your operating profit is essentially gross profit minus operating expenses. So your operating profit now is $30. From operating profit, we subtract our interest expense, which here was we had total debt of 105% interest rate, so it'd be $5. Then our pre-tax income is $25, and then we pay a 40% tax rate on that. So we pay $10 in taxes. So our net income here would be $15. This is kind of a simplified income statement. You can kind of see how it's going from revenue to COGS, gross profit, operating expenses, operating profit, interest expense, pre-tax income, taxes, all the way down to net income. So we're basically at a high level, showing all the goods and services that we provided during the period and all of the expenses, related to that during that period, right? And then we get to our net income. So that is basically at a high level what the income statement is doing. The balance sheet is another financial statement, right? It is showing a business's assets, liabilities, and shareholders' equity at a specific point in time. So essentially, the assets, right? The assets a company has, an asset is just anything with economic value, and the claims on these assets. And the claims could be like an equity holder, or someone that has a liability, or someone that a company owes something to, like a debt holder. That would be a liability. So a company needs assets, either tangible or intangible, to produce cash flows, and the liabilities and shareholders' equity are the claims on those cash flows. I've been talking about that a lot in past videos. Basically, yeah, that's how I would describe it. And the fundamental, most important accounting equation is that assets equals liabilities plus shareholders' equity. At all times for a business, this equation will be true. And this kind of goes into double entry accounting. This is more like an accounting thing. Why this equation is like always true no matter what. Like you can't really mess this up essentially if you're doing everything right. But just know, like conceptually, this makes sense, right? So this is the fundamental equation of accounting. This should always balance. And then you have your book value versus market value. And this is an important thing to note. The balance sheet is all on a like book value basis. So if I buy a house for $50, even though the housing market, let's say, goes up and now it's worth $100, we're not like reflecting the market value, which is like what someone will pay at all times. This doesn't work. We're basically showing the book value, which is the $50 that I paid for that house, and it will stay the same until I sell the house or this goes away. So that's just an important thing to know. This is all book value. It's still relevant to us, right? But that's just something to note. So your assets, right? An asset is something owned by a company that can generate future economic value. So you have current assets and non-current assets. Current assets are assets that can be converted to cash within a year. So your current assets is kind of showing your liquidity. Your liquidity is basically just like how quick your assets can be converted into cash, while non-current assets, aka like long-term assets, will be used for an extended period of time, so typically more than a year. Current assets include cash, inventory, accounts receivable, and prepaid expenses. So I'll walk through all of these. This is good exercise. Cash, we know what cash is. Inventory, yeah, this could just be like the lemonade I have right now that I haven't sold yet. This is a current asset. You can liquidate that pretty easily by just selling it. Accounts receivable, which is important, is essentially money that we are owed for a good or service that we have provided but not been paid for yet. So for instance, if I sell lemonade to a lady in January for $10 and she says, okay, Carter, I'll pay you in February. Now my accounts receivable would go up. She owes me $10 for a good or service that I already fulfilled. So this is basically accounts receivable, and it's an asset because she owes me money. Prepaid expenses is similar, right? Let's say I pay up front my rent for the next 4 months. This is a prepaid expense. And now in the next few periods, I'm not going to have to pay for it. And someone owes me basically, where I'm renting from, right? So this is an asset for us because we've already prepaid for this expense. Long-term assets include PP&E, or property, plant, and equipment. This could be like a factory, for instance, or any kind of long-term asset. And then intangibles, which is, property, plants, and equipment would be tangible. Intangibles would be like a patent or a trademark, etc. So these are examples of long-term assets. This is essentially what assets are, something with that will generate future economic value. These assets from a business are resulting in its cash flows, right? The inventory, the lemonade it has, the lemonade stand, perhaps, all of these things are what is creating value for, equity and debt holders. Liabilities, this is just a financial obligation owed to an external party. So you also have current and non-current liabilities. Current liabilities are obligation a business owes within a year, while non-current liabilities are longer obligations. The one I've been talking about in all these videos has been debt. I've talked a lot about debt, like for instance, a bank loan. A bank loan would typically be a non-current liability because this is usually long-term. I take out like a 10-year loan. So that's an example of a non-current liability. Current liabilities include accounts payable, which is the opposite of accounts receivable. It's basically like when I buy something but haven't paid for it yet. So for instance, maybe I buy lemonade from the store, but I haven't paid for it yet. I say, I'll pay for it next month. We owe them money for what we just bought. So this is a liability. Deferred revenue is interesting. This is basically unearned revenue. For instance, let's say in January, I get paid $100 for lemonade. And this lady says, okay, Carter, you're going to give me lemonade for the next year, once a month. This is unearned revenue. I just got the cash now, but now I owe her this good or service for the next year. So this is a liability for me. I owe this external party something. Accrued expenses is essentially expenses that you have incurred but not paid out. So for instance, let's say my brother works for my lemonade stand for 2 weeks, but I haven't paid him yet. Now I owe him his wages. And then short-term debt, this would just be debt that matures in less than a year. So these are examples of liabilities. It's basically just a financial obligation owed to an external party. Shareholders' equity. So if you remember, assets equals liabilities plus shareholders' equity. We could rearrange this equation to say assets minus liabilities equals shareholders' equity. So it's essentially the residual claim the equity holders have on a company's assets, right? And the cash flows that they generate. Shareholders' equity is essentially the capital raised through equity plus the cumulative profits minus the cash returned to shareholders. So to explain that, capital raised through equity, this is basically just like, I'm selling you a portion of my business and you're going to give me this much money. That is capital raised through equity. So we call this common stock and APIC. Just common stock and APIC are different things, but it's for accounting reasons. Just know that common stock plus APIC equals the capital raised through equity. Retained earnings is total net income across all years minus total dividends. So it's basically all the profits that my business has generated minus all of the cash it is returned to shareholders through dividends. So it's basically like, how much of your cumulative profits have you not paid back to shareholders yet? And then treasury stock is basically equity or shares that I have bought back. So like a buyback, I have also returned that to equity. So you can kind of see how this makes sense, right? It's all the capital raised through equity plus the cumulative profits from when I started to now, minus the cash returned to shareholders through dividends or buybacks, which I've talked about in past videos. So these are the residual claimants after your assets minus liabilities. It should equal your shareholders' equity. So yeah, that's the balance sheet. It's great. This is got an example of the balance sheet. You can see how it's balancing. Let's look at their assets. We have our current assets, cash, accounts receivable, inventory, prepaid expenses, and then we have PP&E and intangibles. So our total assets equals $200, and then we have our liabilities. We have some current ones. We have some long-term debt, and our shareholders' equity. Common stock and APIC basically means that my business has raised $70 across over time through capital, through equity, right? Treasury stock means of that 70, I have bought back $10 of that. I've bought back shares. And retained earnings basically says my cumulative profits throughout time minus all the dividends that I've paid out equals $40. So you can see here that shareholders' equity equals 100. It's 70 minus the treasury stock because we bought back that equity equals 60 plus 40, that equals 100. So you can see here that this is balancing. And for instance, let's do a few like little examples here. Let's say I pay off $10 of debt. That means my cash goes down 10 and my long-term debt goes down 10. So my liabilities and assets both go down 10 and this balances. Let's say I use $10 of cash to buy inventory. Cash goes down, inventory goes up. So again, assets is unchanged and then liabilities, shareholders' equity are unchanged, right? Let's say that my deferred revenue goes up. Deferred revenue, unearned revenue, same thing. This basically means this liability has gone up by 10, let's say. I owe someone a good or service, but my cash has also gone up by 10 because, unearned revenue, I got cash for that. Let's say that my accrued expenses goes down by 5. That basically means that I have paid expenses that I've owed, right? So my cash is going down 5, and my accrued expenses is going down 5. Let's say that your prepaid expenses goes down by 5. This basically means these expenses that I prepaid for are now actually being incurred. I'm actually during this period incurring, or basically those expenses are happening to me. So if they go down 5, that means that I've incurred more of an expense, and that decreases my net income by 5. And net income flows into retained earnings, right? Because retained earnings is just total net income, your cumulative profits minus your total dividends. So if you're incurring $5 more of expenses, your retained earnings will go down by 5, along with my prepaid expenses going down by 5. So this balances. So you can see in all these scenarios, everything is balancing. It's great. So you could think of this happening like hundreds of times throughout a period, but it will always balance no matter what action we take because of this kind of like dual entry. Both things are happening. So the cash flow statement, this is actually what most people would say is the most important statement, because we as investors care about cash flows. Cash flow statement is just showing all the ways that cash is flowing in and out of the business operationally through its investing and financing for a certain period of time. The most important statement as an equity investor, since equity investors derive all value from business returning cash to shareholders. So obviously, like I said, we care a lot about how cash is flowing in and out of a business. So this connects the income statement and balance sheet in a sense. Like if you have the income statement in the balance sheet, you can basically see you can derive the cash flow statement from that. And there's kind of this disconnect with the income statement and balance sheet, right? Because the income statement is accrual based, right? So it's all about when you're incurring expenses and when you're actually, like providing a good or service, but it's not reflecting the actual like way that cash is moving in or out of your business. Obviously, the balance sheet has cash on it, so to kind of connect the income statement and the balance sheet, we have the cash flow statement, which, from the name, it uses cash basis accounting instead of accrual basis accounting. So cash flow from operations is where we kind of make adjustments for the accrual accounting that was in the income statement. So it shows the true cash flow from operating activities. So the core business operations. So because of accrual accounting, net income does not reflect the true cash from operating activities, right? Let's say that I provided $100 of goods or services, but I didn't get paid at all for them. I'm getting paid for them at a future date. This basically would overstate my revenues and therefore net income by $100. So this is definitely not showing my cash flow accurately. So we make these adjustments here. And it basically is you start with your net income and you make adjustments. For instance, you add back non-cash expenses. There's a lot of them, but the easiest, most simple one is depreciation, right? So we should always add back depreciation because it's non-cash, right? I didn't really talk about depreciation that much when I talked about like your long-term assets. And I'm going to do this. I'm going to go back here. We could say, for instance, that my PP&E depreciates at $10 each year. This is an important thing to note, right? Your PP&E, like a factory, is slowly kind of decreasing in value or just like general functionally, right? Like an asset is like kind of worsening over time, right? Like anything, right? You have to make renovations on like a house or anything. If I just sat my house and just like kept it there, it would obviously depreciate a little bit in value. So we do this. So the balance sheet, we could say, is PP&E decreases by $10 each year. And then this would show up on the income statement as depreciation. But depreciation is non-cash, right? If I'm just holding my house and it's slowly depreciating in value, that's not actually like reflected as far as like my cash goes until I actually sell that house. So it's kind of this non-cash expense. It's a bit weird, right? But it's necessary for it to be reflected upon the income statement. I'll probably talk about that in future videos in more to more extent. But yeah, so you have to add back depreciation because it's non-cash. You also have to subtract all of these current operating current assets, right? And I'll just walk through all these. Let's say accounts receivable goes up. That basically means we provided goods or services that haven't been paid for yet. So there's a discrepancy between my income statement, the revenues, and the actual cash I received. So if my accounts receivable is going up, that means my cash is essentially going to be less than what the income statement is showing. Same thing with inventory. Similarly, let's say I buy $10 in inventory, but haven't sold it yet. Or I guess here, $5 in inventory. That is definitely a cash outflow, right? But it hasn't been reflected on my income statement yet because I haven't sold the inventory. So it's not reflected upon there, but I definitely need to get included so my investors have an accurate portrayal of how cash is flowing in and out of my business. Same thing with prepaid expenses. If I prepay for an expense that is an asset, is good for me. However, it's not been reflected on the income statement. So we need to adjust for it here so people can really see what we're doing operationally. Deferred revenue, the opposite kind of, right? I'm getting paid for a revenue that I haven't actually, provided yet, a good or service. So this is not showing up in the income statement, but I'm getting cash for it, so I need to show it here. Accounts payable, accrued expenses, kind of the same thing, right? We are incurring these like expenses on the income statement, but we're not actually paying for them yet. So we should add that, right? So if we add up all of these, then we get to 40. This would be our net change in cash from operations. And I'll talk about this in future videos. This is all just a quick crash course. Cash from investing. This is anything related to buying and selling long-term assets. So buying a long-term asset, this could be like a capital expenditure or an acquisition. A capital expenditure is payments made for long-term assets that are capitalized rather than expensed. So if I just go out and buy like $100 lemonade stand, it would be kind of unfair to show that on the income statement, right? That would decrease my profit by so much in that current year, even though I'm probably able to use this stand for like 5 to 10 years, right? So we kind of spread out that expense across time. And that's what I was alluding to with depreciation, right? Let's say I buy a factory for $100 and it probably will, last for 10 years and it'll be worth nothing. Instead of on the income statement showing $100 expense when I buy it, I instead do a $10 depreciation expense each year. And that's better because each year I'm technically using this. So that's what we call capitalizing like this expenditure, right? Instead of expensing it, which would be just showing $100 expense on the income statement, we're capitalizing it, which is spreading it across a few years. So yeah, this ties back to depreciation and acquisition. This would be like if my company buys another company, that like definitely is a cash outflow for me. And it's from investing, right? I'm investing in this other company. I'm thinking them along with my company will go well. This is an investment. Also, selling long-term assets. This would be like if I sold my factory, this is a cash inflow for me. I'm getting cash from this. So obviously we need to talk about this on the cash flow statement. The cash flow statement is just showing all the ways that cash can flow in and out of your business. So in this case, this example cash flow statement, I'm paying $10 for CapEx, so that's flowing out of my business. And then we are selling a long-term asset for $5, so it's flowing into my business. So net change in cash from investing would be down $5. Cash from financing, this is basically all the external activities that allow a business to raise capital or repay stakeholders. So there's 5 main ways that cash can flow from financing. It could be issuing debt or issuing equity, right? If I, raise debt or raise equity, issue it, then I'm getting cash from that, right? Cash inflow. However, if I pay back debt or if I buy back shares, it's kind of the opposite, right? Cash flowing out of my business. I'm paying them for that. And then lastly is issuing dividends, which is also a cash outflow for me, right? If I'm issuing a dividend, my cash is leaving my business. This would be an outflow. So this is all the cash flow statement from a high level, right? A bit more nuanced than this, but hopefully you understand the 3 sections. You have operations, which is all of the adjustments from your income statement due to the discrepancy between cash-based and accrual-based accounting. Then you have cash flow from investing, which is all about your long-term investments that you're selling and buying. And then you have cash flow from financing, which is all about your debt and your equity and how you're paying these stakeholders and raising this capital, right? So there's all the ways that cash can flow in and out of your business. So this is great, right? So yeah, that's the cash flow statement. This would be how it shows up, right? You have all 3 sections, and then you have your total net change in cash. In this case, if you add all of these up, it would be $40. So, and then after this, that $40 would increase your cash in the balance sheet. So that's kind of how this is flowing, right? These are all flowing a lot. If you just look at this here, net income is flowing to the cash flow statement, and then accounts receivable, all these accounts, they're on the balance sheet. So that's going to change the balance sheet. CapEx, that would increase your PP&E, right? Your property, plants, and equipment. Same with acquisitions or sell of long-term assets. Along with all this financing, this would definitely affect your liabilities and shareholders' equity. So everything going on in the cash flow statement is definitely also affecting your balance sheet. So these 3 statements are really flowing together, which in my conclusion I talk about. Yeah, the 3 statements are extremely interconnected, right? Net income from the income statement flowing to the top of the cash flow statement, but also to retained earnings, right? And the cash flow statement is essentially tying together the balance sheet and the income statement. So it's extremely interconnected, right? So lastly, I'm just going to explain like a common interview question that you'll get. So you kind of see the process logically that I would take to talk about how a change in a company would affect the 3 statements. This is like the most common question they might ask in like a finance interview. They'd say, okay, Carter, walk me through a $10 increase in depreciation. So I'll just tell you what I would say. I said, okay, a $10 increase in depreciation. This would decrease your pre-tax income on your income statement by $10. Assuming a 40% tax rate, now my net income would be down by $6. Moving over to the cash flow statement, my net income down by $6. However, depreciation is a non-cash expense, so we must add that back. So it's going to be -6 plus 10. So my overall net change in cash from operations should be up 4. There are no other changes that need to be made on the cash flow statement, so my overall net change in cash will be up by $4. Moving over to the balance sheet, my cash is up by $4. However, my net PP&E is down by $10 as a result of this depreciation. So my assets as a whole are down by $6, and this balances with my shareholders' equity as my net income of down $6 flows into my retained earnings. So my balance sheet overall balances at down $6. So yeah, that's a common interview question. They might ask other things like what happens when accounts receivable goes up or accrued expenses goes down. But yeah, this is just a very important concept for both interviews, but more so for like analyzing companies and their cash flows, right? When I talk about valuation, I'm going to talk about how you can use accounting and the income statement, all this to project out cash flows. And then obviously, like when you're looking at a discount rate, like right, if a company is losing a lot of money, which you can see with these three statements, this would make the investment more risky and probably increase your discount rate. So it's extremely important for everything I've been talking about: projecting out cash flows, discounting them back to present value. Counting is just a very important topic. But I appreciate y'all watching this, and yeah, thank you.